Hey, what's up everyone? Troy P here. I am setting up the stream right now for today's August 10th session on education. Just give me a little bit of time while I get this stream out. And I know none of you guys are tuned in yet, but when you watch this preview, I don't want you guys just sitting there. So I'm going to move quickly, get this link out to the groups that will be joining, and then we'll go from there. Today we'll be going over support and resistance, which will be interesting for you guys. And then we'll kind of be opening the floor to questions. So just again, give me 2 more minutes to get everything out. I'm sorry for the delay. I had a dentist appointment that ran super late. I messed up my teeth a little bit the other day, running into a door and had to get them fixed. I know that sounds really stupid, and it is, but got that taken care of and am ready to rock. So, yep, just give me 3 more seconds. And so getting started, support and resistance in the foreign exchange market is just like any other market. This trade that we have set up overnight, the Euro US dollar, is one that was heavily influenced by support and resistance, and definitely something that we're going to look at when discussing support and resistance, especially towards the end when we go to do a live example. But to easily identify support and resistance in the market, we'll start with a chart that's a little bit more clean. And something I like to do for new traders is get off the candlestick chart and just go into the line chart. What the line chart essentially is a clean way of looking at the movements in the market like you would for stocks and options on like Webull or Robinhood or anything like that, and just finding the overall, what I like to call critical levels within the market. And what a critical level essentially is one that acts as an area where price likes to return to. So showing you guys what I mean visually with a couple of just basic lines, is that off the bat, looking at price here, I see that this is a critical level because price likes to return to the area here, 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 and then here and here and here. So that's definitely one of the first critical zones I've identified when looking at this chart. And then another one is right here and right here. So this is more of a zone, and they typically come in zones. So like where you find one, you'll find another. And from why that's important is because you can literally draw the zones with and think of them as a point where price returns to, and that will get into what supply and demand means later on when you're a little bit more further evolved as traders. Support and resistance definitely makes up what's known as supply and demand in the market. It's just kind of a fancier way of trading it in a way. So support and resistance, like I said, finding those critical levels that price likes to return to. I definitely recommend using the basic line chart to find that. And right now we're looking at the US dollar yen. So some important levels we found already just on the 30-minute, and we'll zoom out to look at it on another note, is the 1.10 or the 110.15 to the 110.32 area. definitely critical, and somewhere where price likes to definitely trend in. Similarly, another area we found was 1.9065 to 109.742. So both of these zones are around 15-ish pips, which definitely is a big range. But if you're zooming out in the chart, these movements are really hundreds of pips, and a 15 pip, and I'll just show you that they are hundreds of pips. So like from this July high to the July, that might be August, truthfully. Yeah, just the beginning of August. The July high to the July low is 288 pips. So like a 20 pip zone, definitely important to us understanding where price is going to want to go. Oh, sorry about that. Where price is going to want to go from there. I just have someone calling me. Give me 1 second. I think it's from a group, just to make sure that I got this posted everywhere. Okay, yeah, we're all good. And I will be checking comments on my phone too. So if I'm going too fast or if you have any questions, definitely let me know. But yeah, like I said, the zones, super important, usually like around 20 pips on any given chart. And I would say that if you're looking to get into support and resistance trading, the thing you're going to want to start with is finding these critical levels like we did, where price likes to trend around. So like to finish off the top zone, that I had one line drawn here, and this was the other part of the zone I would say is pretty important, and that's going to be a 22 pip zone, which is a little bit bigger. Is that when price likes to trend around these areas, it means that when it reaches them, something big is going to happen. There's either going to be a breakthrough of that structure, which is known as a break of structure, or it's going to test and respect that area. And that's super important for us to know as traders, because when there's critical levels, then we're going to want to plan our trades accordingly around them. So now that we understand on a more simplified level with these charts how we're looking at the critical levels, we're going to go ahead and start to change this back to candlesticks. And the reason that we do that is because, and you have to keep in mind, I drew all of that with the line chart. And you have to, and the reason why candlesticks are important is because they're going to wick above those zones. And in that line chart only averages that price for that candlestick. It doesn't actually take into account the extremities. So if there's like a really long, oops, I meant to go candlestick. If there's a really long wick, it's just going to move the average up a little bit. You're not actually going to get to see the whole thing. So like in our zones, you're going to see the bottom of it. There's a lot of wicks, which is super important because that means that we drew the support and resistance true, which means that this is an area when price comes down, it's going to respect, and if it breaks, it's going to run a little bit. And similarly, the top one, it's going to be hard to break through. So that's the basic idea of support and resistance, that if you're a buyer and you have, say, let's go back a little further so we don't have all that mess. Say if you're, excuse me, a buyer, and this is right here, your resistance zone, whenever the price starts to trend upwards, and you're moving forward and you're moving forward, and you see these candlesticks start to close up around there, you're going to see, and I want to go back just one. Oops. Went a little too far and I messed up. You're going to see price respect that area. So like right here, that one candlestick right before that wick that it showed was super important, because that means that buyers push the price up to that point of resistance, and then sellers made sure that it closed right at that point. So like this true area of resistance might be a little bit higher, like right in here at 133.35. That's more of a true area, and it's actually where price is at right now. So definitely like where price would want to go from a buying side, like if your resistance is, it's always going to want to push up to that area of of where sellers want to push the price back down. And once you break that, you've essentially won. And when that happens, that's when you're going to see the big candlesticks and make the large gains. So like the next candlestick that happens, just want to make sure that I'm not messing that up. That next candlestick was really big. That was a 52 pip candlestick on the 4 hour. So definitely good to know that like when you identify that resistance in the market and can break it, that's when you've broken structure, quote unquote, and gonna see the big movements. So conversely, when you're a seller and you're looking to break what's known as buyer support, we'll make another example here. Say right here is a good example, because these wicks are trying to push price below, and we don't actually get a definite close below it until right here, this candlestick. So zooming back out to just give you a little bit better of an idea. What's happening here is price keeps trying to get closed below this level on the 4 hour. And why that's important, why we want price to close, is because if these wicks that are below it aren't super important, because wicks can go all the way down here. Like wicks can go like hundreds of pips, because those can be influenced by commercial banks. We're more so interested on where price closed, because that takes into account everyone in the foreign exchange market. That takes into account like where retail traders want it to go, where hedge funds want the prices to go, where commercial banks and Federal Reserves, and not Federal Reserves, but big national banks want stuff to go. So definitely important to know that when you're doing support and resistance, you're going to want to do it based on the body of candlesticks, not the wicks. So once we do finally see a close below our seller resistance, which happens right here, well, it didn't close there. This is where it closed, and finally closed below it. Then you can expect to see that big movement occur afterwards, which again did happen and was a 61 pip movement on the 4 hour. So definitely starting to see how when you break the resistance of the opposite person's trade, so say you're a seller and you break buyer resistance, or buyer support, sorry if I got that a little backwards. Once you break buyer support here, then you're going to see that big movement. So buyer support is also known as seller resistance, and seller resistance, which we went over, is also known as buyer support. So I think this was our example. This was our example for the break of structure that allowed buyers to break resistance, which was seller support, and this was seller resistance, which was buyer support. Sorry, this was. So those are our two examples there. And then obviously it's important to know how to use it to your own advantage when trading as well. So say in the foreign exchange market, you want to catch a trade, but you want to see all the support necessary when entering. So a position I might see that might be valuable in this is, say I come in at the beginning of the Euro session, or right before it, 1 a.m. EST is 2 hours before the Euro session, and I see all these 4 hour candlesticks. That's kind of a lot of seller support. So if I was a seller, I would put my stop loss right above it, and that's a very large stop loss. It's around 62 pips, way bigger than I would want to. And don't keep in mind all of that in this example. That would be our seller support. As someone trading, obviously you need to keep a good risk-reward ratio, and this is just a straight-up 1, which is very bad. You want to keep at least a 2.5 to 3. But say that this would be your seller support. You would have all of these people entering, so it's like sellers who entered here and who entered here and who entered here, like all these 4 hour sellers entering before you also have their stop losses set up above that point, probably right around where you have it set. So because all of them have bought at that point, that strengthens your trade. The longer you have those candlesticks, and keep in mind we're on the 4 hours, so this is actually a really long, like showing you this on the 1 hour, you're going to see how long this trend really lasts. where did that just go? So that's a really long trend. You're going to have this whole pocket of sellers entering the market at once, and you're going to use that to your advantage, and keep in mind that they're all going to put their stop loss up there above seller support, and aka where the buyers, if they did manage to break price or try and create a break of structure up here, what's essentially going to happen is it's almost definitely going to get pushed back down, and then it might even again try and come back up and then get pushed back down. So what we actually saw happen here in this example, which obviously I'm doing all this live, have not even checked the examples to know exactly what happened, but it looks like sellers were able to push price down, and at the entry point I was talking about, gain some profit from our entry point at 1.07 or 1.09.2. We would have gained around like 35 pips, which would have been an okay trade. Then what we saw is buyers finally do push that price back up to probably try and stop that momentum that sellers were making from the end of the New York session. They were trying to stop that momentum and break that structure and take that equity in the market, but then it retested that very important support zone that we drew when we were very first starting, to give you that idea of what zones are in the foreign exchange market. We were just talking critical levels. That was something that we drew. And then it bounced right off of that, and then actually came down even further, and then broke that other structure that we were talking about that we randomly drew that was a critical level. So everything's really working out for this example. And then it closed below on the 1 hour, but this is where things get interesting. And this is really important about support and resistance. Just because it closed on the 1 hour below that important level, on the 4 hour does not mean it did. On the 4 hour, it's likely just a wick that came down. And you can see that it is. So that's just a wick that came down on the 4 hour, meaning that this is the price it closed at. But when you're looking at it on the 1 hour, you're going to see that it looks like it, sorry, I'm still on the 4 hour. Hard to maneuver and talk at the same time. So it looks like it closed on the 1 hour below our critical resistance spot, but on the 4 hour it didn't. So that's why when you're finding support and resistance zones, it's definitely important to use further out time frames. Support and resistance is never going to be all that important on the 5, 15, and I want to say 30, but honestly, sometimes 30 can still be helpful for you just to get an idea of what's wicking and where. So I'd say your key time frames for support and resistance are the 30-minute, the 1 hour, and the 4 hour. Those are definitely the ones that I use and definitely what I recommend using to find what closed where. So everything we just went over was basic support and resistance by eye, meaning that if you are to find the critical zones by eye, find where price likes to go and trend around, find buyer support, find seller support, find buyer resistance, find seller resistance. All of that is done just literally by kind of coming into charting and doing it yourself. So there are other options if that was super overwhelming to you. Then another approach to finding support and resistance in the market is what's known as a Fibonacci retracement. What a Fibonacci retracement is basically just measures critical. I don't want to get into much depth about Fibonacci because I know the levels will confuse a lot of people and kind of just save that for another day. But it'll give you key zones. And what I mean by key zones is we're going to find the July high, and we're going to draw this Fibonacci retracement on the 4 hour down to the beginning of August's low. So that's what's like the measured movement we have right here, that 288 pip movement. And getting this out of the way, we're going to see these critical zones. And on the side, on the y-axis, there's numbers. And what these numbers are the 0 to 0.236 zone, the 0.236 to 0.382, which is starting to get super important, and then the 0.382 to 0.5, 0.5 to 0.618, and this little pocket right here Super important. This is where price is going to want to tend to trend around. It's going to usually be the equilibrium price where buyers and sellers agree that that's where price is okay. And you can see from this movement that's exactly where multiple of our key critical levels lie. So the first one we drew here, those two critical levels we saw that formed the first level, right on the middle of that 0.5 level, which means it's halfway between the high and the low, essentially. That's the easiest way of putting that. 0.618 to 0.5 is known as the golden pocket. The golden pocket we can see right here is the very bottom of that other critical level, which is the line that we drew to all of these wicks, which is just right below that 0.618 level that goes into the 0.786. And then obviously there's the highs in there. So, and that's the 0.786, and then that's the 1. So you can see, you get a good idea for how you're drawing this movement to body, and not wick to wick, meaning that you literally draw it to the bodies. And excuse me. So that's body to body right there, and that's very precise, meaning that these zones, as you can see, are going to hold true and be a way for you to find support and resistance and even confirm them, even if you're not super confident with your skills in finding critical levels. It is pretty easy to do. You just look for wicks on when you're finding critical levels, and then you just find lines, and they pretty much make up zones. And keep in mind we're on the 4 hours, so these zones are still like 15 to 20 to 25 pips for the bigger ones. But that's what's known as supply and demand in the market. So supply and demand, like anything that's in an equilibrium, there's going to be people that want to move it out of equilibrium. Sellers are the ones in basic economics that control pricing. So obviously a little bit different in the foreign exchange market because sellers and buyers have equal power, but basically in the basic idea of economics is that since sellers control price, they're the ones that can control the quantity of goods in a market. So a little bit different. Again, we're shifting off from the basic idea of forex and into basic economics, and buyers react to those prices with how many goods they purchase. And there's usually an equilibrium in the market, meaning that buyers and sellers can agree. So in this example, in the actual foreign exchange market, it's very similar. Buyers and sellers are trying to find that price that they agree on. And in these zones of supply and demand is where they find those most often. So there are examples of buyer supply and seller supply, and buyer demand and seller's demand. Sorry, I wanted to make sure I said everything, not repeated any and missed any. But you get the idea, is that there are different zones that are super critical. So that's Fibonacci on top of the critical levels that we've drawn with supply and demand. So that's about everything that I wanted to show you guys for our introduction. Let me come in and see if there are any chat questions. Let me also check the time. So we've been running for around 25 minutes. We don't have the best resolution, I'm noticing, but we don't have any chat questions. So these sessions on YouTube, these are much different than our Twitch streams. These are an education topic that you guys pick. You guys tell me what you want to learn about, and I talk about it. Then I open the floor up to you all to ask the questions that you want, kind of steer the session, and I go based off of that. I want to just make sure I don't have comments turned off, because that would kind of stink. Yeah, so if you guys have any questions, just let me know. But yeah, I just go based off what you pick, and then I open the floor up to go over anything else, and it doesn't have to be supply and demand related or support and resistance related. If that's the topic for the day, you could ask about indicators, and I'd be happy to go over that. So next session, if there aren't any recommendations of what we're going to go over, I'm going to start combining candlesticks with support and resistance and go over a little bit more detail of like why wicks are important, why bodies are important, which we touched on today. But like I want to just visually show you like why is this one 4-hour candlestick that closes into the beginning of this area important, like the wick of it. Like why would this be important? And then how would it be different on say the 1 hour? And would you see candlesticks actually close above that zone? Which you do. And that's how you prevent yourself from getting false breakouts in the foreign exchange market. You want to make sure you're seeing everything. You're going to want to see the full thing close before you're entering. So that is what I want to show you in a little bit more depth next time if there's no questions. So today's session, looks like we do have some questions. You also draw trend lines based on bodies and not wicks. Exactly. So the reason that I draw my trend lines based to the bodies, not wicks, is because trend lines are just another example of supply and, sorry, I went over supply and demand today, which is why I'm going to continue to get them messed up. A trend line is just another example of support and resistance. So while support and resistance zones are usually flat, and let me just get everything else out of here besides our trend line. Not you. So while, say, like, we'll keep a couple of these critical levels, so to speak. So while support and resistance lines are flat, trend lines are not flat, but act as the same way. So when price approaches it, you're either going to see a break of structure and run, which would happen obviously down here because we draw it to the bodies. It would happen like down here, which happens right here. So you're going to see that trend line finally broken, right, which happens right here. A return to it. This is an awesome example. We're getting hooked up to that. So you're going to see that resistance happen all along the whole trend line until we get to this point down here. So you can see it comes up, gets rejected, comes down, comes up again. The wicks, again, closing above there, but we don't care about that. Gets rejected, moves down. Comes back up to test again, doesn't gain enough buyer support, falls, falls, falls. Comes all the way down here to this point where buyers are like, okay, we've had enough of this. This price is so discounted. I'm going to buy so much of it. And so many buyers saw that in the market that this 1 hour candlestick moved from 1.08 or 108.8 to 109.58. That is a 75 pip candlestick. And then it trended right around it, and then it picked up the strength it needed to close right above it. So what we want to see and confirm that we drew correctly is a zoom out like we did with the other support and resistance, where we see where did it close on the further time frames and the shorter time frames. So say 4 hour, we want to know, did anything close above this? And it's not until that one candlestick at 5 p.m. EST that finally broke that trend line. So zooming back into like what the 30-minute would look like. It looks like it closed above here, but didn't. It's not until that 5 p.m. candlestick, or 30-minute didn't close at 5 p.m. It's not until 8 p.m. that we saw it actually close. So like that's actually kind of the converse. The 4 hour showed us at 5 p.m. we closed, but that's because 5 p.m. to 8 p.m. is all one candlestick on the 4 hour. It's not until 8 p.m. that we truly saw the movement here was the one that closed above. And once that happened, we saw sellers say, hey, this could just be a fake breakout. We want to push price back down. And actually closed it on the 30-minute below that. But if you come out on the 1 hour and look, it does look like they closed it there. Let's see about it on the 4 hour. But on the 4 hour, you see it does not close. The sellers could not close that price below the trend line. So trend lines and support and resistance are very similar in the idea of how they function, especially with different time frames and candlesticks, which we're honestly getting super in depth in this session. I wanted to go into next time. And then once you saw that successful break of structure, and keep in mind that this is also a critical level that we're looking at. So it didn't only break this support and resistance critical level, it also broke an important trend line going back to the end of July. So that was very important. And then we saw a run of about 100 pips once it broke structure in about 1 week's time. So definitely a good setup and example for us. Could you go over a good strategy to use? And yes, ask the questions here. Is there any reason you suggest body to body for fib and not wick? Seems a lot for differing opinions. Sorry, I don't know which question to answer first. I'm going to go with you, Pilot Alpha, because this is going to be a simple one. Trading strategies are independent to you. Whatever time frame you trade on might be different than someone else. You might have a job, you might have kids, you might only have an hour to trade a day. So if that's the case, you're going to want to look at the further out time frames. And what works on those might be much different than someone who wants to day trade and sit in front of the charts all day and trade 5 to 6 different pairs and have a bunch of indicators applied. They might, if you have less time, you might want to focus more on candlesticks and trend lines instead of like indicators and like quicker moving approaches to technical analysis. So that's what I would say to start off my answer to your question. But then I will get a little bit more in depth in saying that you will have to figure out what works for you in terms of what is financially acceptable with risk management. Each currency pairs move different ways. Everyone always asks me, hey, can you do analysis on gold? And I say, no, I don't trade gold, so I don't feel comfortable giving you my analysis on it because it would be no better than anyone else in this groups. So like figuring out which currency pairs work for you will also decide how many pips you like to see currency pairs move, what times you trade in the day. I like the euro pair, so I'll trade the euro sessions quite often. Then you'll also have to just back test your strategy in general and make sure that it works with everything I just talked about. So like if that's what you mean in terms of a trading plan, completely individual to you. You'll need to figure out what you like versus what you don't like and start to kind of build off that. It'll take like a year plus to come up with a trading plan that works for you, risk management, time-wise, and return-wise. Probably over a year. Mine's taken like 3 years to really get where I'm at. And right now, mine's basically built around day trades that have a high % win rate and can keep a decent risk return. Sometimes people like to have like a 1 to 10 risk reward and like to only take like 1 trade a week. I clearly can't do that because people would not get in the trade right away and not have a trade for a whole week. So I have to take more trades and make sure that they're in profit. So completely up to you. But if you more so mean like, hey, like I want a basic strategy to try, then I guess I can show you one real quick, and then I'll get into order block, and then I'll get into, what was your question? Hey, Melissa, how are you? I'll get into your question, Z, after that. So just, and I'm going to go over this really briefly, but a quick strategy, one of the ones I use on Sunday when I'm doing my analysis, and I actually went over it on Twitch yesterday for the trade that we have open with Euro US dollar, is I said, hey, the Bollinger, I guess I do have to explain it before I just go into where it's at. So the Bollinger Band strategy is essentially 5 bands, and if we're going to just start with a 3rd standard deviation, because that's really the most important one. It's unfortunate that it's also the hardest one to see, so I guess I will use the white. I'll use 4. That's fine. So this band, that's super hard to see. I'm sorry, I'm gonna have to use 2, which is not what I wanted to do because it's closer in. But this is this is 2 standard deviations away from the closing price of the candlestick. So the reason that that's important to the average of that. The reason that's important to us is because it tells us if price moves too quickly. So when price comes out of this zone, like it does here, you're typically going to see price bounce off of it. And you can see it touches here and then goes back up. There's no correction off of this one, but that's the basic idea of the strategy is when it pops out of that zone, you'd see a correction So like it happens here, bounces out of that, comes back out. Like you can see, just like if it moves too quickly, it moves too quickly. You're going to see a correction occur after it. So that's the idea of the Bollinger Band strategy. And then what I did is I said, hey, I want to see all 5 bands at one time. I want to see standard deviations 1 through 5. If you've ever taken a basic statistics course, you know that anything outside of the 3rd standard deviation is considered irregular. And the reason for that is because I think it's been a while. I am a stat major, and my last stat class was less than a year ago, so this is bad on me for not remembering it. But we didn't go over bell-shaped curves. We were doing applied multivariate analysis, so a lot different than what I was learning and going over now. But I believe 99 or 97.5% of the data is within 3 standard deviations for the regular bell curve. So when it touches that 3rd standard deviation, that's super irregular, and you're going to see a correction occur. So the reason I want to know that is because when price touches that 3rd standard deviation, it means it moved way too quickly. This movement is from NFP, which is completely normal because like that's fundamental analysis. That's gonna happen. Price isn't always gonna be able to correct off that 3rd standard deviation. So again, that's why no one indicator strategy is ever gonna work. When it comes to that 3rd standard deviation, I say, hey, that moved way too quickly. This one came to the 4th, touched, and then really bounced out. So like the reason I like this is because on Sunday, I say, hey, are there any currency pairs where the price is at the 3rd standard deviation? So on Sunday at open, I can go ahead and enter a retracement type trade, trying to break the trend and go back to the upside. So that's a 5 Bollinger Band strategy. That's a very basic one. And then there's a 3 EMA strategy. And the exponential moving average is pretty simple to use. Basically, what I want to see with this one is when price is below the 9, 9's below the 20, and 20 below the 50, it's a good time to sell. So let me find exactly where that happens. That happens right here. 9 goes below the 20, 20 goes below the 50, and price is below all of them. This would have been, we're a little too far out. Let me find exactly where it happened. It happened right here. This would have been our official entry point right there. Maybe a couple candlesticks over, like right there. I'm going to say right there. That's our official entry. And from our entry point, we would have made, there's not going to be a ton of pips. We would have made like 85 pips from that strategy. I would say I probably would put my stop loss like right up around there. So it would have been a decent trade using this strategy. It's just a good way to find entries. So a lot of different strategies, a lot of different things you can look at. Doesn't mean they're all going to work all the time, but like those things are okay to start to implement into your trading plan. There's a lot of things you can put into a trading plan. What settings do you use for Bollinger Bands? I got you. You use the close. You use, and like I said, I use all of the standard deviations. I just need to see what candlestick count I use, which is 50, which means the last 50 candlesticks is the one that I look at. So a 50 count is always really important to me. And then the last question I'm going to be able to go over before we wrap up is there any reason you suggest body to body for fib and not wick to wick? Seems a lot. So I went over that already in pretty detailed. Like I did go over that in detail, but I guess just to really teach you about it in more detail, I wish I still had my fib up when I saw that question, is because wicks will happen on different time frames, which I again said was going to be the leading topic for next week. Basically, like, let me draw you back what I had for the high of July to the low of the beginning of August. So I'm not going to make this perfect because I do have to run. But the reason I draw it to the bodies and don't care about these little wicks here and here is because wicks can close all the way up here, like say a wick close like all the way up here, I don't care about that zone because sellers or buyers weren't able to maintain it. Sellers put the pressure back on to close it down here, and the reason we care about where it closed is because everything is pretty much based off of the close price. Every indicator is based off of that. All the trend lines I draw are based off of that, and it's not just me. Like many people draw their support and resistance zones, their fibs, their indicators, everything to the closing price, which is why we care about the closing price when drawing fibs. Well, I guess I just double repeated myself, but the reason is because wicks can be as long as day. There can be a wick that, say there was like an institutional movement that went all the way up for like 150 pips, like a wick that looks like this. That doesn't mean anything to us. Like we don't care. Like, did people get stopped out of because of that, or hit crazy take profits up there because of that? Yes. But does that matter to us if they can't maintain that price up there? No, it does not matter at all. They couldn't keep the price up there. Sellers were like, okay, there's so much room for us to make money back to the downside that we're entering up here, and we're taking that price all the way back down to where it is at equilibrium, which is what this whole session was about, in finding support and resistance and supply and demand and equilibriums. So I feel like I answered that in pretty much as detailed as I could get. If you didn't fully understand, then I would say just rewind to when I first went over. Oh, no worries. I wasn't trying to say that you missed anything. I'm just saying at the end of this, you'll be able to rewind and get a better idea of what I was talking about. Like, so I wasn't trying to be rude or anything. I appreciate the awesome question. By the way, all of you guys tuning in, doing a great job. I know you guys, some of you are over in the London time zone, which it is about 8 p.m. over there, I think now. So I am going to wrap up. I hope that this was helpful. If you guys have any steering topics for next session, definitely let me know. Any feedback or anything, feel free to comment or message me on Telegram or whatever. So I will see you guys. I'll have to check my schedule to see when we're running the next one. I know there's another one this week, but I'll see you guys when I see you. Take care, everyone.